Hi, I'm Wyatt.
And I'm Grace.
And you're listening to our dad and your host of the Vacation Rental Revolution podcast.
What's up, guys? Welcome to another episode of the Odyssey Vacation Rental Revolution podcast. I'm your host, Sean Moore, and we're here with one of our favorite lenders again. And if you've listened to his podcast in the past, this is Jeff Chisum with Northpoint Mortgage. And Jeff, you are officially the first repeat interview that I've had. So congratulations on that. That's exciting. We'll have a repeat conversation about some of the financing, which is a big piece of the puzzle when we're buying vacation rentals.
Well, it's an honor to be here. I appreciate you having me again. And I mean, I don't want to brag, Sean, but I was looking through all of your videos, and outside of kind of your personal story, which is amazing, everybody should go and watch that one. I think our first podcast we recorded is maybe like top 3.
It's definitely the fan favorite. We talked a lot about 10% down financing for the vacation rentals and building a portfolio with 10% down financing. We're going to talk more about that today. And then we're also going to introduce a couple other financing products and that you have the ability to write loans on now. And it's going to be really exciting. So for those of you who missed the first episode, we dove into kind of Jeff's, his story, where he's from, and what got him into this space. We talked a lot about his family and his journey into vacation rentals. Jeff's a owner of, you have 2 properties now, right, Jeff?
2. Yep.
Two lifestyle assets. And so we talked a little bit about that. So we won't repeat all that stuff, but if you missed it, go back to, I think it was episode 29, and go listen to that. And we're going to now add to that. This is kind of part 2 of that first episode. So I'm really excited to dive into some of the more detailed questions that we're getting about the financing side of life. And so I appreciate you as always being on here. Jeff's a member of our group inside of Odyssey, and is always very generous with his ability to jump in and answer questions and help a lot of our members build their portfolios. And so, Jeff, I believe our group has kept you pretty busy, right?
Yeah, we've had a lot of fun. I mean, it's just amazing how many great people I've connected with through the group, and it's fun to run with people that are doing significant things. So yeah, it's been great.
Awesome. Yep. And those of you listening, some of you are watching this on YouTube, some of you are listening in your car, but Jeff and I get along great because we have the same haircut. And so, which is a lack of
2 good looking bald guys. Yeah.
There you go. Well, that's, I always get along good with bald guys. So that's good for us. Awesome. Well, Jeff, what I'd like to dive into right now, one of the things that we get questions about all the time, and I know you do as well, and I get a lot of comments sometimes on our, some of the like on the podcast that we recorded, and people telling us, and even other lenders and realtors and people in this business that say, hey, you guys can't do vacation home and second home financing when you're using them as short-term rentals. And we know that not to be true, but can you talk a little bit about that? And so that people that are wondering, well, are you allowed to do that? Can we talk a little bit about that and the rules that Fannie and Freddie have around that, and where it would be applicable, and why some of those other professionals may think that we're not allowed to do that?
Yeah, it constantly blows my mind how much misinformation there is around this topic, around this opportunity. In fact, the phone call that I just had 30 minutes ago with a lady interested in buying a lake house, she told me, and she's a realtor, her lender in this scenario where she wanted to buy this lake house in this destination area, she was going to have to put 20% down because they were going to not only enjoy it, but also utilize it as a short-term rental. So it's something that repeats itself on a common basis, a consistent basis. So to dispel all the misinformation, the rumors, Fannie Mae loves the idea on a second home occupancy loan that you're going to have a borrower that can fully qualify for absorbing this proposed PITI payment in their debt to income ratios without any consideration for the income that it may generate or it could generate. And then, to have an ability to supplement their own ability to repay that mortgage, they love the idea. So to kind of summarize, and there's no quote out there on this, but I think they would say, hey, let's broaden our policy. Let's make it as liberal as possible, so we don't put people in a position where they feel like they're committing mortgage fraud.
Yeah.
So the policy is, as long as you intend to occupy this property at some point during the year, and you don't put yourself in a situation where legally you lose the ability to occupy that property, then you're meeting the terms and the requirements for the second home occupancy. And that, when you sign that rider at closing, and it's important that this is a Fannie Mae loan, that your lender is originating a Fannie Mae, because they have the most liberal STR friendly policy. You're only committing to that for a year. So after a year, you can transfer the title to an LLC without any worry of recourse, that they would execute the due on sale clause. And then you could get into a long-term rental if you wanted to. And that may look like 30 days or more. So yeah, they've made this opportunity very easy for people without worry that they're doing something that they shouldn't be doing.
Yeah. And that's, I think, what scares people the most. None of us want to get into trouble with the fine print or otherwise. We don't want to take on loans like you talked about, like mortgage fraud or loan fraud, and get a loan product and use it for its unintended purpose, right? And so and we talk about this all the time, if you have the intention to use it personally and you don't lose control of the property, which is what we talk about, lifestyle assets, right? We buy these properties, we do want that personal use aspect. And so we definitely want to be able to use them when, if and when we choose to, and not lose the ability to make that decision of when we want to use them. But outside of that, Fannie is saying that we're allowed to go short-term rental it, and we can put it on Airbnb and in VRBO or even with your management company, as long as you don't lose control of that property and the ability to use it when you want to use it. That's correct, right?
That's exactly right. And I don't have statistics on this, but just based on my experience, what I've seen out there, and I will say, if you've got a loan officer that is telling you can't put these properties on Verbo or Airbnb, that's old policy. It used to stay in Freddie Mac's policy that you could not do that.
Yeah.
But with this modernization of the policy, with them saying you just can't put yourself in a legally binding situation where you couldn't occupy that property. If you look in the fine print on Verbo, Airbnb, they will specifically state that they are not facilitating a legal lease agreement. So that's the situation where you're not going to get sued if you cancel a reservation. You're going to be a bad guy. You may be kicked off the site, but there's no legal lease agreement in place in those on those platforms. So back to my statistic, I really think that there's only about 10% of loan officers actually know the correct modern policy, updated policy. I think there's only about 2% of us that actually have a correct interpretation of the policy and then have done enough deals to vet out that understanding of the policy or the interpretation of the policy.
Yeah. And I think that's important. I don't know that the policy used to state that you couldn't do it. And so if you have a loan officer that you've trusted and you've used and they're giving you this information, they haven't kept themselves up to date of some of the new changes. And second, like anything else, if you don't write a lot of these types of loans and it's not what you primarily do, you probably don't even have a very good interpretation of what you can and can't do based on what the policy states. Because my guess is, Jeff, that not everybody reads all the policies of all the loans and all the programs, especially if it's not loans that they write all the time. And so, you do a lot of these loans, right? So you're, this is a significant portion of your business, and you guys are at the, in the top 1% of loan originators in the whole US. And so, I mean, you guys are way up there, and this is a big portion of your business. So it makes sense that you would know this, and somebody that doesn't write a lot of these loans maybe wouldn't know that as well.
Yeah, we've had to fight, underwriters' misinterpretation of the policy, their lack of knowledge. So yeah, having done a lot of deals and going through those battles with even the head of underwriting in some cases, we've been able to, hold that up, and it stood, our understanding and our interpretation of the policy. And we've been in situations where people have had to eat crow because they were wrong and we were right. So experience matters for sure.
Yeah, absolutely. And like anything, not all, nobody in any profession, everybody's not created equal, and not everybody specializes in the same thing. And so if you are looking at doing this, we're obviously on this episode and our previous episode, there's ways to get a hold of Jeff and his team. They can underwrite loans in all 50 states. And so we'll make sure that you have that available to you in the show notes and everything else. But it's probably worth talking to somebody, if you're considering doing this, who really understands the rules and regulations. And then, if you should be able to do this, because none of us want to do something we're not supposed to be doing. And, nobody wants to set themselves up in that, even in the gray area of saying, well, maybe I can get away with it, maybe I can't. And I've even heard loan officers say that, like, well, I'll do it for you, but there might be some consequences on the back end, which makes you feel like, it's like, don't tell me that. I mean, if I'm not supposed to do it, I don't want to do it. Right. And so it drives me nuts when I hear a loan officer say that as well.
Yeah. None of this is worth going to jail over.
No.
So
no. And we wouldn't be in here talking and saying it's okay, Jeff, particularly because this is what he does for a living. And, if we weren't really 100% confident that you're able to do this, which we are. So now, Jeff, there are instances where this doesn't make sense. And what I wanted to do today is also introduce a couple other options for people, and a couple other financing options as far as different loan programs and different, products, portfolio products that you guys offer right now, and that are available to consider if this isn't. Because one of the things that is, these loans we're talking about, these 10% down, second home, vacation home loans, they're full doc loans. You have to qualify with your debt to income, has to qualify, your credit score, all of those different things have to qualify to be able to buy this property without any rental income, right? It's a full doc loan that you've got to be able to qualify to pay on your own without rental income. And so sometimes that's not always the case. And, especially if you're a business owner, you might write off and not show enough income. Maybe you've already got, so many properties in your portfolio and your debt to income's too high, whatever that ends up being. There's reasons why we want to look into other loan products. And so there's a couple that we wanted to talk about. And, one of them would be that we were talking about previously before the show started was you guys have a bank statement loan that's a portfolio product for Northpoint that we were talking about that was really interesting to me. Can we talk about that and when that would be an applicable time to maybe move away from this regular traditional second home loan and then look at some of these other products?
Yeah, absolutely. And I've talked to enough people where I would say, 30%, if I talk to 100 people, 30 of those people don't fit in the Fannie Mae box. And so it's usually business owners, a lot of times as well. It's the people that have maxed out that Fannie Mae debt to income ratio. So we'll talk about that one here in just a second. But yeah, for those people who are self-employed, where on tax returns, their tax return isn't necessarily a reflection of their actual cash flow in their business, the bank statement loan is a great option. So there's different levels of that. There's opportunities where we can just review 12 months or 24 months. But basically what we're going to do is an analysis of your cash flow situation and convert it into a monthly income amount. And then, it would be the same as if you were a salaried position. We take that annual salary, divide it by 12, and that's the gross amount is the qualifying income that we would use. So we're going to do basically the same thing with your bank statements, come up with a gross dollar amount. So we're still calculating debt to income ratio, but we're doing using the income piece off of the cash flow of your bank statements.
So what if we're running down that road, and I've done a couple of these loans and a couple of bank statement loans, not with you guys. This was in previously, and they were both different, and they both had different criteria. And we know that to be true with any portfolio type of a product, right? That a portfolio product means that whatever bank is holding that and writing the rules, they're writing their own rules. A Fannie and Freddie, the criteria to get a Fannie or Freddie loan is going to be pretty much the same across the board. There's very specific criteria you have to follow. A portfolio loan product, in which we're talking about with these bank statement loans, they can be very different from bank to bank. So you may have had an experience with a bank statement loan that could be very different than what Jeff's talking about here. And my personal situation we were talking about earlier, I went through a broker and it was a 3-year deal. And, I qualified for a really high amount. And then by the time it was said and done, it was about 1/4 of that amount. And so there's a lot of different things. So if you've had an experience with this, it doesn't mean it's going to be the same across the board, right, Jeff? This is a portfolio product to you guys that is a little bit different than what I was going through earlier.
Yeah, and that's a huge difference. So, if you don't talk to me, you talk to someone else about a bank statement loan, the first question you want to ask is, who is actually doing this loan? Are you brokering it out, or is it a true portfolio loan? Because those are two different ball games as far as experience, the timeliness of the process. So if you got someone that's brokering out that loan, they are absolutely sending all your stuff out to their underwriter, who's probably going to piecemeal the file. So in other words, they get to a stopping point. So let's say there's 50 things they have to go through. They get to number 2 and they get stuck there. They're going to send it back to your loan officer, ask for additional documentation, clarification, then send us back the file. And then they go to maybe number 10, send it back again. And each one of those delays is a week. And then you get to the end and you find out, oh, I didn't know, the loan officer didn't know about that rule or that qualification or, some aspect of their product. So that's a big deal, is to find out if that is a true portfolio product. And if it is, that's a much better situation, because at Northpoint, for example, that's our product. We write the rules. Our underwriters review everything. So if we find that an exception needs to be made, we can request that. And if it makes sense, we've got the people that can make those decisions here. So it's a much faster process. It's a much smoother process. And like we were talking about earlier, Sean, we're gonna pre-underwrite those every single time. So we're gonna run that through an underwriter before we issue that pre-approval letter. So one thing that I would say about those loans, and it's really every situation, but especially these, you don't want to find that great property and then call your loan officer and say, hey, I want to make an offer and do a bank statement loan. How fast can you get me a pre-approval letter? That's when mistakes are made. That's when, things aren't properly reviewed, and you just don't want to be in that situation.
Yeah. And that's across the board, right? When we're talking about getting financing on a property, you don't look for your financing after you find a property. You do that. That's one of the very first steps in the process, is getting pre-approved, deciding what loan program or what loan product you're going to use, depending on your situation, what type of property you're going after. All of those different things those conversations should happen way before we start looking at properties even. And so, that's going to set yourself up for success just in that's the order of the way that things go down, is you're going to do your financing way before the property search. And so, yeah, what is the typical time frame? Do these loans take longer than a traditional loan? What would you say the escrow time if I made an offer after we've already talked, assuming that we've already looked at everything from offer to close?
It's 30 days. Yeah,
Okay.
the same as, most deals that we do. So and again, that's because we're going to pre-underwrite these files and you're going to be, ready to go. One of the questions I get all the time is, when should I get pre-approved? And the best answer for that is when you think that you're within a 6-month window of wanting to make a move and close on a property. So, yeah, you definitely don't want to put yourself in a position where you're scrambling to get that done. No one wants to operate in a way where they feel like they're flying by the seat of their pants in this space, because we're not making light decisions. We're not buying a hamburger, in the drive-through at McDonald's. You really want to make sure that you're prepared. And just me personally, when I feel more prepared, I feel more educated. I feel more empowered to go out there and make a decision, make quick decisions, or be able to make quick decisions because I am prepared, I am educated. So it puts you in a position where you can take action and you feel like you're taking wise action.
Right. It gives you that confidence to just say, okay, that piece of the puzzle is checked off, and it allows us to, and gives us the confidence to focus on the deal and putting together the best deal rather than worrying whether we're going to be able to get the financing. And so we know that one of the big hiccups right now in the world we're living in, like today, on the financing side, is appraisals. They're coming, they're taking a long time, and that's across the board, right? And so, you really have to be prepared with everything else, because some of those things they're taking extra time right now, and sometimes we don't have that extra time. And if we only have a short window of extra time and it's already allocated to the appraisal, for example, everything else better be in line before we get going.
Yeah, and that's exactly right. And I'll forewarn all of your viewers and listeners that you may get a shocking number when your loan officer tells you need to be prepared to pay $1,500 for an appraisal, $3,000 for an appraisal, because what we're finding in these markets, the Smokies, Blue Ridge, I don't want to single them out, but their money talks right now. Those appraisers have more than what they know to do with. And if you want to get your deal done, you better throw a big number out, because that's what's going to catch the attention of these appraisers. And they can pass on orders. They don't have to pick them up. So, they're definitely cherry picking right now. And we're having to throw big numbers out there to get their attention, to get them to pick up orders.
Yeah. And as frustrating as it is, it's still worth it usually, because the deal that we want to go after, that we want to pursue, is going to more than make up for that. But it's still frustrating. We don't want to pay more than we have to. We had one of our members was in New Mexico buying a property, and they were in the middle of a 1031 exchange. And that's exactly what they did. They weren't going to hit that timeline. They were right down to the wire on the 1031 exchange. And the delay was the appraisal, and they went out and they threw a huge number out and said, we'll put this number out there, but we need it back in 2 days. And they got it done, and that's exactly what they did. And so unfortunately sometimes, but it's nice to know that you have the ability to do that if you have to. Some lenders wouldn't even suggest that. I've talked to loan officers and lenders that wouldn't even know that that's an option. They just assume that you just have to wait it out. And to your point, they've got way more appraisals to do than there are appraisers to handle them. And so they cherry pick them. And one of the best ways to get that done is throw out a little bit bigger number than everybody else is willing to pay to get your property appraised in on time. So let's go back to the front end of the bank statement loan and how I would qualify for that. So if I'm a business owner, are they going to use my business bank statements? Are they going to use my personal bank statements? How are they going to do that?
Well, sometimes it's a combination. So, it just depends on what is going to be the most advantageous for you. So that's why that pre-approval process is important. So we can review your position and what things look like, and then we'll determine, the best path going forward. So it can vary.
Okay. And so, also sometimes I kind of assume, because I've done some bank statement loans and I understand them a little bit and haven't gone through that process, that I assume that the listeners maybe understand exactly what that is. But tell us exactly, like, as far as like terms, what we're looking for when we would use them, down payments, pricing, all of that kind of stuff. What would a typical bank statement type of a loan look like, if I was going to run down that road, as far as what it would cost me to do it?
Yeah, so this is our prime preferred product. So, you still have to have excellent credit, 760 or above. We can get some exceptions on 740 and above. So you still have to show that, you're responsible with credit. You've got good scores. But yeah, the beauty of it is we can still do the 10% down up to 3 million. And that's for more than just people that are doing bank statement loans. That may be, the fully qualifying W-2, everything looks good on a tax return, where, instead of putting 20% down on a $4 million deal, 10% may be a much better situation. So interest rates, I can't quote exact rates, but they're typically going to run 1 to 1.5% above what you would find on a second home occupancy loan. So not too terribly bad. You can still get fixed rate options.
Does a fixed rate option cost you more? Is it usually more than that 1 to 1.5% jump, or is it?
No.
Yeah.
There's not a lot of value in the adjustable rates going with that going down that road. So yeah, really good fixed rate terms, 30-year amortization. So very solid there with the loan structuring and the terms.
How about prepayments? Do they have prepayment penalties on these types of loans?
Not on the preferred prime. Yeah,
okay.
we can talk a little bit more about the DSCR loans where there is a prepayment penalty there. But
that's why I asked on this one, because I know on the DSCR loans, which we'll talk about here in a minute, there typically are prepayment penalties that step down. And so this might be a really good option if you're, if you want to avoid that prepayment option. You've got great credit, you've got, significant dollars coming into a business or to your bank account. I know a lot of business owners will typically have the majority of the money run through the business, and they don't typically put a lot through their personal accounts. And so that's why I asked about being able to use business banking and for this type of a loan and what you guys offer.
Yeah, no, that's a great point. And again, yeah, we're going to advise people on what's going to work best for them and put them in the best position with the best solution.
When you talk about a preferred prime, what does that mean when you refer to a preferred prime loan?
It's just our terminology for the product. So, the preferred prime is because people have excellent credit. So we do have options for, 1 day out of bankruptcy. Some of those catastrophic events, credit wise, we still have products for those. So the preferred prime just refers to the aspect of the credit profile being strong.
Awesome. Good. I figured that was the case. So that's just something that you guys, it's a product that basically tells you've got to have really good, strong credit to be able to get something like that.
Yeah, that's exactly right.
Awesome. And so, would that loan still be a personal loan that goes on my personal debt to income and everything else? I can't do anything as far as putting that product in an LLC. That's going to be in my name.
Yeah, all the opportunities that we have, the loan is in your personal name, hold title in your personal name, and then, like I mentioned earlier, after a year you can transfer to an LLC. But yeah, everything's going to be on your personal credit. We can do 5 of those portfolio loans at Northpoint. So
okay, awesome. So let's go to that kind of the third product that we were going to mention and talk about, which is a DSCR loan. Some people have heard me talk about them as asset-based loans, and these are loans that basically the property itself qualifies. We don't qualify with our own income. And, they're going to look at the property and how the property is expected to perform or is performing. and be able to underwrite the loan in that way, right? And the DSCR stands for debt service coverage ratio type loans, if anybody's looking that up. And so that's another product that we could use if we don't want to use our own income to qualify, correct?
Yeah, that's exactly right. And so one of the questions that I get on a regular basis is, how many can I do? So with Northpoint, we go by the Fannie standards. You can have up to 10 mortgages in your name. We can do up to 5 of those types of loans. But we're not going to look at income. We're not going to consider income. It's not even going on the application. It's really credit score. So you have to have a 740 or higher. You have to show a good history of using credit responsibly. And then if you have that piece, then it's all about the property's ability to outperform the PITI payment. And Northpoint loves these properties because, they've been doing these for a while on investment properties and using that data. And what they're seeing is that these properties perform really, really well and kind of blow the long-term rental model out of the water from a qualifying standpoint.
Awesome. And so when it comes to and this is kind of the same point that we made with the bank statement loan, is this is another portfolio loan, right? And so where we talk about a DSCR loan, there's other lenders who offer DSCR loans. They will all have their own unique rules and terms and everything else. Sometimes they're similar, but the bank itself, Northpoint, is writing the rules for this type of a loan to keep within their portfolio. Is that correct?
Yeah, that's exactly right. And again, that's a big deal because, sometimes if you've got someone that's brokering out that loan, whoever that lender is that's, underwriting the loan, it's their deal. I've seen in the past where their appetite changes and the rules change because, they're going to tighten things up because in that moment, they don't want to do as many of these loans. So overnight, their credit score requirements could go up. Different aspects of qualifying could change because of their appetite. So again, it's a big deal to have control of that product and it be a bank portfolio product.
Yeah, and in fact, the biggest problems I've seen with DSCR loans are when one of our members or people that I've talked to that have had a nightmare experience with this type of a product, it's because they went through a broker. And we've talked about this, and you always want to find out if somebody is actually, how far removed from the decision makers are they? And if you're a broker, your job is you've got a lot of lenders that you can go out to, and there's nothing wrong with brokers. I know there's a lot of brokers that do an amazing job, and the brokers who have had issues with these have done a good job. But what happens is they're pretty far removed from the decision, and they don't have a lot of say when it comes to if there's an issue with the underwriting or anything else, and if the rules changed in the middle of it. And so you want to really ask that question in the very beginning. If you're looking at some of these types of loans, is this a portfolio product for you? Are you funding it? Are you keeping this product in your portfolio? Because if the answer is yes, then your loan officer is not that far removed from the decision makers. It's within their company of, and the underwriting's on their team, the decision makers are there. If the answer is no, it tells you they're a broker and they're going to be a little bit further removed from the decision makers. And that's just riskier. The level of risk goes up for you as a borrower to be dealing with, when you're not dealing directly with the decision makers. My experience with the bank statement loans, both bank statement loans I have done in the past, they were a marathon. We ended up getting them both done, but it changed significantly from where we started to where we ended up. And both scenarios, I was working with a broker I trusted and worked with a lot, and still trust her. She does an amazing job, does a lot of our loans but now she only does loans. And in fact, she told me before we got into the process, she said, "Hey, Sean, I'm brokering this out. I really don't want to do this for you. I don't do this for anybody. If you want to run down this road, I will." So I kind of went into it with my eyes wide open, but she said the same thing. She said, "I don't like brokering stuff out." The same as you talk about that, Jeff. It's not, you really want to be careful if you're not dealing with the actual direct lender.
Well, none of us like playing a game where we don't know the rules up front. We don't like shooting at a moving target. And that's kind of the best way to illustrate what that looks like. And, not to come down on our broker friends, but it's just a different beast. It's a different animal where that can happen. The rules can change. You don't have control of the process. And you said earlier, for the most part, Fannie is Fannie. They really don't change hardly ever. So that's a little bit more consistent, and being able to deal with other entities because the rules up front. It's not a moving target. It's sitting there for you to hit the bullseye.
Yeah, but some of these unique products, it's a lot more. And I appreciate you making that clarification, because there are a lot of brokers who they strictly deal with traditional Fannie products, right? And that's nowhere near as big of a deal because the rules are pretty much the same across the board. Everybody's following the same rules. They don't change very often. They're pretty much set in stone, for lack of a better term. They're there, and everybody's dealing on the same playing field. When it comes to some of these additional products like bank statement loans, asset-based loans, DSCR loans, those things, they are different across the board. And in fact, I always suggest people when they're looking at a DSCR loan to look at a couple different direct lenders. There's not a lot of them out there. And so you can look at a couple different ones and see what the terms would be, what are their different qualifying requirements and how are they underwriting the loan. And those things can be different across the board. I don't want people to assume that because they look at a product that you might have, Jeff, that, lender B is going to be exactly the same, because they're not on these portfolio products. You have to ask the questions because they might be similar, but they're not going to be the same.
Yeah, absolutely. And so what I would advise people with is, tell me about your control over the product and the process. What are the upfront fees? What is the rate? What are the terms? So can I get a 30-year fixed rate, or is it a 20-year with a balloon payment in 7 years, or do I have to go with an ARM? So just get an understanding of what available terms are up front instead of when your disclosures show up. And then also, is there any type of prepayment penalty? So those are the big ones that, and then, will you pre-underwrite my file as much as possible? Or if I find a property, can you, advise me on the feasibility that it's going to, qualify? So and with that, it's communication. Do you have easy paths to communicate with, or 3 days, 5 days, 7 days going to go by and I don't hear from you? We lose deals when that happens. So communication is, finding out how people communicate up front is important as well.
Yeah, nice. Yep, absolutely. Usually one of the most important things in any sort of relationship, but definitely with your borrower-lender relationship, is that communication piece. So with the DSCR loan, let's talk a little bit about the general terms and what are some of the kind of the key criteria for getting into one of those loans. As far as down payment, I know we can't put exact rates, but roughly what that rate jump would be from typical prime rates. And then, if they have prepayments or not, we've already kind of alluded that they do. So what are some of those terms on the DSCR loans?
Yeah, so I can speak a little bit to other companies, definitely to Northpoint. So you can still get a 30-year fixed rate. Minimum down payment is 20%. There are no upfront origination fees. Some other companies that I've seen will charge a point, 2 points up front. I think I've even heard of companies that charge 3. Mm-hmm. The prepayment penalty that Northpoint has is pretty minimal. It's based on the loan amount. It's pretty complicated calculation, but it's pretty minor fee compared to some of the other ones that I've seen out there, where they can charge you as much as 5 points if you pay the loan off within the first year, and then it kind of stair steps over 5 years down to 1 point for that last year. So yeah, definitely a question that you want to ask up front is, what is that prepayment penalty? So we have fixed rate options. The rate is typically going to be 1.25% to 1.5% above what you would find with the second home occupancy loan. So again, not crazy, not anything that's a double digit or anything like that. They're very, very reasonable rates for, the opportunity that it presents.
Yeah. And are you able to buy down those rates on those types of loans?
You can. Yep.
Yeah.
There is that opportunity.
If you know you're going to be holding it for 5 years, you can run the calculations and probably see whether it makes sense to buy those down. But rates are so low right now that 1.25% to 1.5% jump in a rate is not usually that's usually a pretty decent rate still. The rates are, because rates are so low right now, that makes a lot of sense to still look at these types of products, especially if you don't qualify for these loans with your personal, with your debt to income, or, you're already maxed out on your debt to income and you can use the property. This uses the property income to qualify for the loan. And explain to people what a debt service coverage ratio is. That's what these loans are called. Can you explain to people what that actually means and what it is and what you're looking for in these types of loans?
Sure. So they probably can get a better explanation through Google. But yeah, they're going to look at the rent records in the area of properties that are similar, and we'll also use different data sources. So when the appraiser goes out, he's going to use an appraisal report that he would use if he was doing a long-term investment property. So he's looking at comps that operate as long-term rentals, but in these areas we can't necessarily depend on those. Because there may not be a lot of those. So there's a couple of other data sources that we use that also include short-term rental income. And really bottom line is we want to see that those properties or that property has the potential to outperform the PITI payment.
Yeah. Yeah. So you're looking for a certain ratio between the income it generates and what those expenses, the PITI expense, would be on the property, and want to make sure that it covers that. And so, and that's the basic, not basic, that's how they underwrite these loans outside of the credit score of the borrower. Now, these loans, though, don't have to hit your personal credit and on your loan, right? Or do they with Northpoint? I know with some lenders, they don't, and you can lend right directly to an LLC.
Yeah. And that's another question to ask. I would definitely put that in, those series of important questions that you want to ask up front. And that's, depending on who you go with, may be the determining factor, because Northpoint, like I said, everything that we do is in your personal name. And there are other companies out there that will do the loan in the name of the LLC. So those terms are typically going to be different. So again, that's where you want to find out, okay, great, I can do it in the LLC, but I'm going to have to pay 3 points up front, and then I'm going to have this huge prepayment penalty. So, or that may not be the case. They may be very friendly and they may have this huge appetite for doing those loans in the name of an LLC and not have those fees. But you've got to know what questions to ask up front to make sure that you're going with the company that's going to be a good fit for you.
Absolutely. And sometimes you don't know all those questions. So it's really important to have a loan officer that can walk you through a lot of that, and navigate a lot of those questions. It's very common in not just this business, but many, that we have all these offerings. We can lend to an LLC. You do 20% down. We can do, amortize over 30 years and all these different things. And even though they can do them all, sometimes we don't realize that, okay, lending to an LLC actually costs me more. Yeah, I can do it, but it's going to be more than that 1.5 point jump on the interest rate, or I'm going to have these big fees up front, or my prepayment penalty changes. And so just because they can do it doesn't mean you're always going to get the best pricing with all of those different options as well.
Yeah, that's exactly right. And that's why I love being at Northpoint and having the different products that we do, not only with just Fannie Mae in our portfolio, but it's nice to be in a situation where you do have different boxes that you can look in, you have options for people. Options are just good to have in these scenarios, because sometimes plan A for some people isn't the same plan A for other people. So
Yeah.
it's nice to be able to advise people and say, okay, I have this, we can look at it. So I haven't had that in the past. I'm excited to have it now.
Yeah. And one of the main reasons why I was excited to have, part two of our initial conversation, because you've done an amazing job. You guys have really, become the industry leader when it comes to 10% down financing for vacation second home loans. And now you have the ability, when you consult with somebody, to really decide, okay, we've got these different product offerings. And not every, like you said, 30% of the people don't fit into that first box, which is the most favorable box to fit in as far as terms, down payment, all of those different things. But that doesn't mean it fits for everybody. And before, you used to not have much of an option unless you wanted to broker it out, which you didn't do. And you said, you didn't run down that road. And so you had the one option, and now you have different options. And it's more of a consultation when somebody comes to you to say, okay, let's figure out what fits your scenario the best, what your property goals are, what your personal finance goals are, and all those different things. And having those options, I think is critical. And I'm really excited for you to have that. We have a lot of trust in you. A lot of our entire community has a lot of trust with you and your team. And so it's nice to now have that ability to say, okay, yeah, we think this product's the best fit for you, or, product C might be a better fit. And so it's really exciting to see you have that.
Yeah. And, I like to help people. And I also have the mindset that we can always be better, do better, and offer higher levels of service. And so through transitions, that can be challenging, but ultimately, with our transition to Northpoint, it's just exciting that I will be able to say yes more to people's needs and when they don't fit inside the Fannie box. So we're excited that we're in all 50 states. So that pre-approval letter travels to anywhere anyone wants to go if they're undecided up front where they want to invest. So we're excited to be here.
Awesome. Well, so as a summary, so we talked about 3 different loan products. One, we talked about the traditional vacation home, second home loan, and it is that we talked about, the misconception that you're not allowed to use that in short-term rent, your properties when you have that type of a loan. And hopefully we've crossed that bridge and checked that box for a lot of the people who had questions about that, because you absolutely are. You definitely have to have that personal use aspect to the property, which and not lose control of the property. So if you have any questions about that, Jeff can talk about that. Him and his team can talk about that. When they're talking to you. The second product was that bank statement product, which I'm really excited to hear about, because that gives a really great option, a 10% down option up to $3 million. That's phenomenal. And being able to use bank statements, especially for all those business owners out there, this is a good product for a lot of business owners that, typically have a lot of write-offs. And by the time their tax returns are done, that the income is whittled down to show not quite representative of actually what they do make and the cash flow that they have. And so that's a great product to be able to talk about. And then that third product, which is an asset-based loan, which is a product where the property itself qualifies for the income rather than you personally. And so those are all 3 very unique products. You guys, they're the bank statement and the DSCR asset-based loan, they're portfolio products to Northpoint. And so I'm really excited to be able to have those options, point people in your direction. And so as we talk about that, Jeff, you had some contact information we shared on the last podcast, and then you made this transition from Gateway to Northpoint at this point. How can people get a hold of you that want to talk to you and maybe set up a consultation to talk about what their best option is as they run down this road?
Yeah, so we still have 10%down.com spelled out, and that'll get you to my calendar where you can go in and open up a day, find a time that works for you, and we'll schedule a call to talk about what your hopes, dreams, and desires are. And there's a lot of information out there people can go and consume. pretty much anything that they want to these days. And what I find is these phone calls are invaluable because we can get really specific. We can talk about strategies. Another thing that I'm excited about is our opportunity to offer HELOCs.
Oh,
So,
yes. Yeah. Talk a
you,
little bit
you,
about that before we wrap up. I think
yeah,
that's important.
Yeah, absolutely. Because I love the strategy of using a HELOC for down payment, closing costs, and setting up the property to have it rent ready. So I just like the idea that, we're going out. Yeah, these properties are fun. We're going to use them, but ultimately we're buying businesses. And that's where we get into people calling them investment properties. But um, we're going out there, we're acquiring these businesses. So we need to separate that business debt as much as we can. And the HELOC is a great way to do that versus doing like a cash out refinance where you're tied to that additional debt for maybe even 30 years. And there's other things that affect that or can come out of that. Your debt to income ratio is forever tied to that higher PITI payment if you do that first mortgage cash out refinance. So let's separate that debt that we're using to acquire the business and then make the business pay the debt back. So we can help people with HELOCs on their primary residences, their second homes. And I think it's a great opportunity to use that static equity that's just sitting there, but doing it in a way that, we can isolate it. We can concentrate on paying it off with the property's income that we're buying. So Sean, you may have a different number, but a number I like to throw out is 18 to 20%. So, how much do I need? I say 10% down payment, 3% for closing costs. So bank fees, title fees, prepays, first year of homeowners insurance, and then about 5% to get the property rent ready.
Yeah. Yeah. And I actually have upped that a little bit as well. I usually tell people it's about 8 to 10% to get the property rent ready if you're starting from scratch. A lot of these properties are sold semi set up, turnkey. A lot of them are called turnkey, but usually we don't see them fully turnkey. We need to go add to it. And so if that's the case, you maybe 3 to 5%, but yeah, even if you're on a 10% down loan, you should be budgeting around that 20% mark to get this property purchased and ready to go. And so, and that has to do with some of those closing costs. And then also the bulk of that extra is going to go into furnishing and setting up that property. And so, yeah, I'm glad you mentioned that HELOC. We were talking about that earlier, and because we see so many people leveraging their properties to be able to accelerate and build their portfolio right now. Most of us that own properties have equity in them right now. I mean, the fact of the matter is most markets have been going up very significantly. And so rather than selling our property or doing a cash out refinance where you have to take a bulk sum and it's amortized over your 30 years and you just have that payment stuck on there, a HELOC's great because you can tap into exactly what you need. You can pay it off. You can actually use it again. You can kind of keep going back and forth with that HELOC and use it as almost a banking system for you in building this and really accelerating your portfolio. How hard is it to qualify for HELOCs, Jeff? Is it, are they typical to a regular loan? Are they different? What does that look like?
Yeah, because there are some, there's risk in being in the second lien position where if something catastrophic happened, the second lien position gets kind of the leftover. So,
yeah.
It is your fully qualifying loan based on your debt to income ratio with your documentable personal income. So similar to the Fannie loan. But not anything crazy from, low debt to income ratio or anything like that. So pretty easy. Most of the appraisals that we do, if not 100% of them, are electronic evaluations. So the turn times are fairly quick. Now, what I would say to that too is, don't wait till the last minute if that's your strategy, which again, I think it's a great one. I talk to so many people that, we go through the conversation, they're excited about the opportunity for 10%. And their kind of last comments are if we could just skip enough meals and save enough, we'll be able to get to that point where we can do this. And, I love that HELOC to leverage that equity and leave your personal bank accounts alone, because most people starting a business wouldn't go and dip into their personal savings and checking account. Yeah. They're going to go get a business loan. So you got to think in those terms and that way. And there's a lot of people that, could be doing this, but, they're kind of stuck in that rut of, we just can't save enough. And you don't want to be 80 years old still having that, that thought of, gosh, if we could have just saved enough, we could have done, all these things.
Yeah. But one of our most successful members, when we actually didn't have the cash to do it, and leveraged a HELOC on his property for $150,000, got into a property, and he's been into the game for a year and a half, has passive income over $200,000 a year, and has over $1 million of equity with the 2 properties he's purchased. And so it's pretty, and he was never kind of to that point of being able to save enough cash to do it, but he had this HELOC that he was able to tap into, and his life has completely changed. And so you want to, and we're not talking about over leveraging properties here, right? You're not taking 120% out of your property or anything like that, right? There's limits to what you can do here, but most people have equity in their property, but you're not able to tap into all of it, right, Jeff?
Well, yeah, and that's a great point, because you can only go up to 80% loan to value. And so, there's some protection in there that you're not over leveraging. You're not going to get yourself in an underwater position. Are we guaranteed what's going to happen in the markets? No, but that's a pretty safe place that you're going to leave 20% of the equity in the property.
Yeah, absolutely. But when you have it, and a lot of people do, what a great resource to be able to put into play, right? Put it into something else that continues to build for you, and build that long-term wealth and that lifestyle freedom that we're all after. And so, Jeff, this has been awesome, man. I kept you longer than I said I was going to keep you, so I appreciate you spending a little extra time with us today. This is a great conversation. I know it's one of our hottest topics, and this is, I'm sure, going to be rivaling our first episode, which is one of our top viewed and listened to episodes. So again, thank you so much. So people can go get a hold of you. The best spot, you said, is at 10% down, all spelled out. And so same as the website that we had on the first one. So we're not confusing people, but that's great. So go to 10percentdown.com, go visit, set a time up to visit with Jeff and his team, to be able to say which option is the best option for you, right? Like Jeff said, there's plenty of information online. Go do your due diligence, everything else, but there's nothing beats a conversation, because everybody's situation is so unique. And so, we're Jeff and his team are so willing to get on the phone and run and have these consultations with you. And I can truly say this is a consultation, and they're going to point you in the right direction and tell you that it's not the right fit if it's not the right fit. And that's one thing I very much appreciate you guys doing is really taking that service mentality on these consultations. I've had more than one, many people tell us how that conversation has gone and how valuable it was to them. And now you have a lot more resources, which is really exciting. And so, again, thank you so much, Jeff, for being here. We'll go to 10percentdown.com, find you guys, set up a time to talk. And as always, guys, I appreciate you listening, joining us on the podcast on YouTube. If you get any value out of these episodes, and leave us a review, share it with somebody that you know, give us a thumbs up. Those things do matter to us. And as always, we'll be back with you next week, same time, same place. And in the meantime, do something today, just one thing today that you can go start building that life that you don't want to take a vacation from. Cheers, my friends.
Thanks for joining us on this episode of the Vacation Rental Revolution podcast. Share this with other people you think need to hear about it. And don't forget to subscribe and leave us a review. Hey Grace, is there a website? Yes! For more amazing content and expert advice, visit Vodacy.com. Thanks for listening, and we'll see you on the next episode.